Hello and welcome everybody to According to Andrew number 117, non-reserve and fractional banking all rolled into one system. So this is kind of a theory that I've been kind of pinging around in my head, and I wanted to kind of get it out there, get people's opinions on it, as I think uh, it helps explain some aspects, and it's kind of taking bits and pieces from Steve Keen and Richard Warner, Jeff Snyder, and George Gammon, and kind of putting them all together. And I think it fits. This is kind of a theory slash um, hypothesis at this point. And I was trying to model it up in Keen's Minsky program, but I was kind of having trouble figuring it out. And I just wanted to get this out there, and I was going to model it up later. So, what do I mean by non-reserve and fractional reserve banking all rolled into one? So, I see there being a major problem in our current system. Jeff Snyder talks about this all the time, that there's not enough collateral, and the question comes, the question asking is like, why? Why is there not enough collateral? What about the system makes it so there isn't enough collateral? And I think I've figured it out, and it also explains why no matter how much money that the government pumped into the banking sector, it couldn't fix the problem of uh, not enough collateral and stuff like that, and just not enough money in our overall system because the way the system's functioning. Basically, what's happening is things that should remain in the banking sector are sold to the private sector, and this is causing problems because it's not actually increasing the money supply. So, what I mean by that is there's kind of two ways of doing this. So let's pull this up real quick, and I will share my screen. So here's kind of the way things work. Some person wants a loan for XYZ business. The bank creates the loan, and then what happens in our system is that the bank then sells that loan to a third party. Uh, Mortgage-backed securities are a perfect example of this. Somebody wants a house, they go to the bank, they buy a house, then the bank takes that loan, combines with a whole bunch of other loans, sells this on to various other uh, non-bank entities. This creates a problem because when the person takes out the loan in the banking sector, it creates money, right? So you have the principal that the person asked for creates the money basically out of thin air, and then when that loan gets paid back, that money is removed from the system. But the thing is, the interest is not, though. The interest is basically what goes and pays the banker, and then so that will recirculate back into the system. The problem happens, uh, like let's say that they got a 30-year loan, right? Well, okay, it's going to take 30 years for that principal to be paid all the way down, especially since they amortize the loan. We're not going to get into that, but basically you pay all the interest up front. So the actual money supply doesn't start shrinking until you start paying off that principal. And it's paid in small chunks over time. Well, what happens when the bank sells this loan off to a third party is it takes that principal amount right out of the system immediately. And so when they create the loan, they create new money, and then that money is taken from a person that isn't in the system and it's paid to them, and that money is removed from the system. So there's a net zero amount of money increase in the system. Now, this isn't necessarily a bad thing in certain times because, kind of the whole point of capitalism is supposed to be efficient allocation of capital. And so if they're buying this loan, in a sense, it's that third party that had capital that wasn't, basically the bank is acting as an intermediary in this exchange where they're finding people that have capital that they want to invest, and they're finding people that have a idea that they want, or some amount of money that they need, and they're pairing those people up, and then they get a cut in the middle for that service. And that's a fine service to have, but it can't be the only thing and how the entire system works, which is which is basically how it works now. And I think people talk about like at Glass-Steagall and investment banking and stuff being, and commercial banking being allowed to run rampant and taking out all these risks and stuff like that. I think what actually caused this issue is the true distinction is investment banks are supposed to be uh, basically middlemen who are connecting people who need money with people who have money, and being a middleman for that investment vehicle. And then if the person goes bust, that person that loaned the capital loses out on money and stuff like that, and that goes towards productive enterprises. That's absolutely fine. But when money needs to be created, that's done in the commercial banking sector where uh, somebody has a loan for an idea of a thing, or they need a house payment or something like that, and then they print the money into existence. I actually don't think people should be printing money for banking things, so maybe mortgage-backed securities are the proper way to be doing this. So the advantage of doing it in the middleman system is it will increase the velocity of money, right? If money's sitting on the sideline, it's technically not being allocated properly, and that's resources that could be used to invest in new things, grow, be spent on capital equipment, and grow the overall wealth of the economy. Uh, Generally, in America and most modern economies, this is taken to an extreme, to where there's no savings for a rainy day, and that's when the recessions that we're about to go through and things like that take a massive hit because there's no cushion in terms of savings and capital built up because it's all shoved into trying to just make the system more and more productive, and eventually, when that doesn't work out, everyone goes bust. Um, but this is a really important key thing because it goes to show how the banking system why there's inflation or deflation in certain things. So what I mean by that is when a person takes out a loan from a bank, they create money, right? Let's say that person goes bust. The bank, let's say it's a mortgage, right? So the bank will get the house, and they'll have to cut down the supply of the thing. But the thing is, let's say that the bank is making enough money on its other forms of revenue that if all of their loans went bust, they would still be able to operate as a bank. If that's the case, then them taking a haircut on the overall loan like isn't really a big deal, right? They invented $300,000 into existence for them to be able to buy the house, and then for them to just cut out $300,000 from their bank balance sheet, it's not a big deal because that money was invented out of nowhere basically to create the loan in the first place. You compare that to when they sell it onto a third party, and now that $300,000 actually is a realized loss on their balance sheet because they had to spend $300,000 to get that loan in the first place. That was actual cost associated with them, and the idea was they're going to get paid back like $400,000 over the life of the loan. And so that's where if you have lots of defaults and they're all tied within the banking sector could basically write it off. It's not a big deal. There'll be some redistribution of various capital and stuff like that. There will be a bit of a recession in terms of because basically all the capital that gets sucked into the banking sector needs to be reallocated in efficient manners, and so there's going to be economic slowdown in terms of that. That's mainly a result of money velocity dropping, but the actual amount of money in the system won't be affected. It will be a net neutral operation because when you write that off, it's basically like the money that was going to be sucked out of the system is printed into existence to pay off that other side of the bank balance sheet, and then the money that was already spent in the economy remains in the economy, and so it doesn't actually cause debt deflation, which is a spiraling problem. Debt deflation will kind of somewhat still be realized in this system because it's going to cause a severe drop in the money, or not the money supply, the money velocity as people start hoarding their wealth more, as because uncertainty is going to make it so, okay, can I make those payments and stuff like that, and the more cushion people have to be able to cash flow things when things drop, the less of a problem this will be. The problem is right now we're at such a point that if people aren't getting that next payment, like they're running things where it's like they have to hit all their cash flows at max capacity or they go bust. And that's how a lot of people are running things nowadays, and it's technically the most efficient use of capital, but it is also the most fragile use of capital. And that's not something that generally the economy is focused on or geared towards. Now you compare this to the other one, because that money was sucked out of the system when that person goes bust, it effectively creates deflation in the system because now that person isn't getting paid and all that stuff. Now it shouldn't actually, like, the actual money supply doesn't change, but the basically when a bank is selling a loan to a third party or a bond that is gonna this person's loan becomes this person's this person's liability is this person's asset. When this person goes bust, again, the velocity just drops off a cliff. The actual amount of money in the system shouldn't change because it was already reduced when this person paid the bank for the bond or the loan. Yeah. Oh, but it does cause it because of what I was talking. What this whole thing is started of. So there's reserve list and there's fractional reserve in our system. So how does that work? So banking is reserveless or not non-reserve banking. So basically, because this person has a promise to pay the bank can create the money out of thin air, and that's the privilege that's given to the bank by the government. Because as the economy grows, you need the money supply to grow. There is questions on whether or not growing it through debt is the best way, and there's issues with it. But from all of the studying I've done, it is the best proxy I have found thus far. If someone has a better idea, I am more than willing to hear you out. So leave that in the comments if you can. The other system basically does this where they sell this loan on. Now, it'd be one thing if they just kept the loan, but they don't do that. What they do is they hypothecate it. So basically what that does is, if people are familiar with a HELOC, which is a home equity line of credit, that would be like taking your house and being like, okay, I have so much equity in this house, let's say $500,000, so 500,000. I'm going to take $100,000 loan against the value of my house. And then you're going to take that and you're going to buy treasuries. And treasuries are a pristine collateral. So then you take those treasuries and you take a loan against those treasuries to go buy something else. And then you take a loan against that stuff to go buy something else. And you're never using all of the so like you bought $100,000 worth of treasuries, and then you're going to take 10,000 of that, and you're going to take a loan against the 10,000 treasuries, and you're going to go buy something else, and then you're going to take a loan of $1,000 off of that and buy something else, and then 100, and and eventually it asymptotically reaches a certain max limit or whatever. That's basically that basically creates a fractional reserve system, and that when that breaks causes a massive amount of deflation because everyone basically has a claim on this underlying. There's like 5 or 6 claims for the same collateral by the same amount of people, and obviously not everybody can be paid that amount. And so when a default happens, because there's a huge chain of people with tons of counterparty risk. This is basically what happened in 2008. This huge chain of people with tons of counterparty and stuff like risk all throughout this entire system. That whole chain basically breaks down if one person in the chain basically can't pay their loan. And then there's a clamor to try to get all of this money back from everybody, and it causes the entire system to collapse. That is what causes this massive. That's what's going to cause this massive deflationary bubble, debt deflation spiral that's going to kick off. And there's not, unless you are basically going to invent money to make all of those various bondholders that have rehypothecated things like 1,000 times whole. There's no real way, like the 2008 bailouts times 1,000, like it would be trillions of dollars. It would maybe even be like quadrillion or more amounts of money needed to bail out this entire system. And then like as we've seen with 2008, like they bailed out the system and didn't do anything to fix the system. Because this whole way of doing banking still underlies everything. So, yeah, so that's kind of what's coming, and what I see as how this whole system kind of works together and clicks together. It's got a lot of issues, and it needs kind of fixing. The best way I see as fixing it is create that separation between commercial and investment banks again, but then change their mandate, because the mandate, when I read it, didn't seem to clarify this. Basically, you should have a banking sector whose job is to create money, and you should have a banking sector. I guess it wouldn't even almost necessarily be a banking sector, but basically another sector of banking in which their job isn't to create money, but it's to link people who need capital with people who want capital, and be the intermediary there. And there's a lot of different forms that takes in our society today. But the banking needs to get back to its core of creating money when it's needed. There needs to be certain limits placed on it so that it doesn't just create money willy-nilly, and that money goes towards productive purposes. That's why I don't think mortgages should really exist, or at least not. People shouldn't be creating money to get a mortgage, right? The person wants a loan, bank wants a loan, creates money. This should not be used for loans because the creation of mortgage loans, because that's one of the reasons that we've seen these asset prices being driven up is because people are taking out loans to buy those assets. So they're basically printing money to buy the asset, which then drives the price up. Some of it has to do with actual value, but a lot of it has to do with this factor. Houses are a number one reason, or houses are a big example of this. Cars are another good example, right? Because loans didn't used to be so prevalent for cars, cars used to be much more affordable. Now they've gotten to crazy levels of expensive, a lot of times on a large part because of the amount of auto loan that you can get for a car nowadays. And that's still considered a depreciating asset, and they've been inflating like crazy. It hasn't gotten to the point where, well, I guess in 2020, but that was mainly a supply shock as to why what was normally seen as a depreciating asset all of a sudden appreciated massively. I think that covers everything I wanted to on this topic. So yeah, that's kind of the theory. Basically, because banks are selling loans to third parties, they're no longer doing their function of creating money. This has been offset so far with money velocity, but we've kind of run into the money velocity and making up for the lack of money creation through rehypothecation of collateral, because we've basically run out of collateral to rehypothecate, and we've hit that upper bound, but we still need more money in the system, but banks won't create the money. There's nothing we can kind of do, and we're about to see a freeze up of the financial markets. I believe this is what happened in 2008 with the great financial crisis, is, again, there was this lockup of the financial system because there wasn't enough collateral, because we had to switch this system because banks were doing their job of creating money. So if we get banks back to their job of creating money, then we won't have to, the private sector, or basically the market, won't have to create this crazy system of rehypothecating money to create the amount of money needed to actually circulate throughout the economy to run the various financial systems and wealth generation type stuff. A lot of it is some kind of Ponzi games and stuff like that, but also there are aspects of it that are necessary to make the system function. So it's kind of a gray area, and I'm still figuring out exactly where I land on some of these things like rehypothecation and stuff like that. But that is kind of the summary of it. Thank you guys all for listening. This ended up being, I ended up being able to kind of condense that down better than I was hoping. So hopefully that was clear for you guys. If you guys have any questions, leave them in the comments. We're on BitChute, we're on Gab TV, we are on YouTube, and I'm also on where all podcasts are available, your Apple, Podbean, Google Podcasts, Spotify, all that good stuff. So listen to me wherever you like best, and thank you all for listening. Have a good day.